Imagine logging into your bank account tomorrow morning. The numbers on the screen are exactly the same as they were yesterday. But when you go to buy groceries, you realize those exact same numbers can no longer buy a loaf of bread. When major global conflicts erupt, they can immediately sever the supply chains that deliver everyday necessities. As basic goods become scarce, their prices rise. The paper currency sitting in your wallet doesn't change, but what it can actually purchase disappears. In 1923, Germany faced a currency crisis so severe that 30 years of savings could be wiped out in a single season. The government printed emergency money, issuing notes worth 1 million and even 5 billion marks just to keep pace with daily costs. This happened again in 2008 in Zimbabwe. Inflation moved so rapidly that the central bank eventually issued a note for $100 trillion. Citizens carried stacks of paper worth trillions that in reality couldn't buy a single meal. Cash is a promise made by a government, and during a geopolitical shock, that promise is under immense strain. Holding pure cash during a crisis means holding an asset that is effectively bleeding its value. When the public realizes their currency is losing value, a predictable psychological chain reaction occurs. People rush to the bank to withdraw their capital and convert it into physical goods. This mass panic is a bank run, and it threatens to drain the entire financial system. To prevent a total collapse, governments often intervene to protect the institution. They impose withdrawal limits or lock the doors, legally allowing the bank to restrict access to your capital at the moment you need it most. These systemic panics are often triggered by a shock to energy routes. When a conflict threatens the Strait of Hormuz, a checkpoint for nearly 30% of global oil, fuel prices can spike overnight. Because the modern economy relies on fuel for everything, that spike acts as a contagion. It dries up the cost of transporting food to supermarkets, powering our basic utilities, and manufacturing survival goods. This leaves many people in a severe liquidity trap. At the exact moment your cost of living reaches its peak, the banking system can often restrict your access to the very funds you need to survive the inflation. To halt wartime inflation, the IMF notes that central banks must use a blunt instrument. They raise interest rates to slow the economy down. This creates a dual squeeze on middle-class households. First, daily living expenses rise because of inflation. Then, as the central bank steps in to fight that inflation, your borrowing costs rise to match it. This zone represents a massive gap in affordability. Variable rate mortgages become significantly more expensive every month. Auto loans and business debts compound rapidly, moving much faster than the growth in your paycheck. These measures are a calculated trade-off for national stability. To maintain global financial credibility and stabilize the currency, central banks prioritize cooling the macroeconomy, even when it results in heavy burdens for individual debt holders. Holding debt during a geopolitical crisis creates a massive vulnerability. Governments will often sacrifice personal financial stability to ensure the broader economy doesn't enter a terminal inflationary spiral. When war suddenly breaks out, uncertainty peaks. The natural human instinct is for retail investors to log into their accounts and rush to sell off their portfolios before losing more value. However, history shows that markets hate uncertainty more than they hate bad news. Whether it was Pearl Harbor or the 2022 invasion of Ukraine, markets often stabilize the moment the conflict becomes a known reality rather than a feared possibility. This chart tracks the market's reaction to major global shocks. While the initial drops in 1987, 2020, and 2022 were steep, they were followed by a V-shaped recovery that erased the losses in months or weeks. Pulling your money out during a crash means missing the most explosive growth days. Historically, missing just the 10 best trading days erases over 50% of your total long-term gains. Panic selling permanently locks in your temporary losses. It guarantees you will be mathematically poor when the conflict ends and the recovery begins. If cash is losing value, debt is compounding, and panic sellers are losing their equity, where is that wealth actually going? Wealth is rapidly shifting away from the paper economy, digital numbers and fiat promises, and migrating into the real economy. For centuries, physical gold has served as a primary insurance policy against collapsing currencies. Even today, the central banks that issue paper money continue to hoard massive reserves of physical gold to protect their own balance sheets. Capital also flows into productive, tangible assets. Investors shift their wealth toward agricultural land and essential businesses. the companies that provide food, fuel, and medicine. These assets maintain their value because they provide intrinsic utility that cannot be printed or frozen. You cannot artificially create a fertile acre of soil or manufacture the global demand for energy. Geopolitical crises trigger a massive wealth transfer. Capital moves from those holding fragile paper promises toward those holding tangible, productive assets. Surviving a crisis requires aligning your wealth with reality rather than illusions.